Okay, welcome everybody to this week's CDAR seminar. I'm Denise Goldberg, one of CDAR's co-directors, and it's my extreme pleasure to introduce someone you all know, Shachar Kariv, who's going to tell us about behavioral economics a little bit.
Or maybe anti-behavioral economics.
Anti-behavioral economics,
Yeah.
we need it. So
Yes.
thank you for that. Ever since Allais and Ellsberg. So those are paradoxes.
Those are paradoxes.
And
that
maybe
I
we
will
can
explain.
find out what they are if we don't already know them. So please take it away.
All right, thank you. So because this is a risk seminar, I'm going to talk about preferences towards risk. But what we are going to cover is applicable to any types of preferences, preferences towards time, what we call social preferences, preferences towards other people, but we'll focus on risk preferences. All right. And you know, in a seminal paper in the early 80s, in 1982, Hal Varian basically wrote what he thought are the 4 types of fundamental questions that we need to ask in applied economics about preferences. And I would argue in the talk that part of the problem in the profession is that we didn't actually follow Varian's marching orders. We skipped some questions. We taken as given that the answer to other questions are one way or another when we answered other questions and so on and so forth. And the purpose of this paper and the entire research agenda is actually to systematically answer these 4 questions. Okay, and I will explain what do I mean by systematically answer. So let's suppose that I observe some behavior of people making decisions under risk. The first question that I need to ask myself is this behavior consistent with the model of utility maximization? Can I even think about people as maximizing the utility function, their choices maximizing the utility function? Here, the answer to this are choices consistent with complete and transitive preference ordering. Okay, so this is the most basic question. If the answer to this question, now, of course, the answer cannot be yes or no. It's a model. All models are wrong. So also the model of utility maximization is wrong. The question is how wrong it is. So we actually need a measure whether the model of utility maximization is a good model of behavior. If so, only if so, then we can move to the second question. Is behavior consistent with the utility function with some special structural properties? Of course, the second question is meaningless if the answer to the first question is no. Now, if you think, Lisa mentioned at the beginning, behavioral economics is not really behavioral at the end of the day, because most of behavioral economics actually assuming that people are maximizing the utility function. Usually, this utility function is going to be a utility function that the people in behavioral economics are saying are motivated by some psychological insights, like loss aversion, for example. But in practice, what this utility function will be, it will be a more flexible utility function. And actually, the most behavioral models in economics are basically becoming to be stories in Greek letters. There are actually so many parameters there that they can never be falsified. So if you think about the entire debate between standard economics and behavioral economics, it's not here. There is, of course, work in economics about people having incomplete or non-transitive preferences, but this is not Kahneman and Tversky. This is not the behavioral economics that you know and that is actually taught here, and we are the mecca of this behavioral economics. The behavioral economics will basically diverge from standard economics on the second question. Okay. Expected utility, for example, has very particular strong structure. Well, all non-expected utility model in which there are, you know, in the double digits already, they are going to be basically having a less restrictive structure on the underlying utility function. This makes sense? The Neumann-Morgenstern independence axiom that I will explain is basically providing a lot of structure on the utility function. The difference between expected utility and loss aversion is not about utility maximization. It's about what utility function people are maximizing. All right?
So just so I understand, you're saying that there are lots of different functions, and classical rational economics is one set of them, and Kahneman Tversky is another set.
And I will show this, I will even show what this is.
So like you're thinking like one of these prospect kind of curves, is just another utility function.
Of course.
Of course it is, but it has a different, it doesn't go like this. It goes like that.
It is more flexible. Exactly. So you do with your hands like this.
That's how it does yoga.
It can do a lot of yoga, actually.
Yeah.
All right. The next question after this is, can we actually recover the underlying preferences from observed choices? This is a completely different question. Many times in economics, we are actually jumping immediately to this question. How do we do it? I have a set of data, and I'm basically imposing the utility function on the data. I'm writing the demand, and I'm fitting the demand to the data. But of course, I have an identification problem here, because I'm doing two things at once. I'm testing whether the model that I impose on the data is the correct model, and I'm also trying to recover parameters of interest. So unless we actually pin down what is the structure of the underlying utility function, then Houston, we have a problem. How do we usually do it? Let's suppose, just for the sake of that I'm actually maximizing some utility function. But you, the experimenter, you don't know which utility function it is. So you're just imposing utility function. And then you write the demand, and you want to fit it to the data. So you have some error structure. Whose error is this? It's not my error. I have no error. I'm maximizing utility function. It is your error, because you don't actually know which utility function I maximize.
But it's done all over science. People
That's
say
the
normal
problem.
distribution, I'm gonna fit the variance,
This
right?
is exactly the okay.
It's not just here.
Of course. So what? If everyone is jumping from the roof, we should join them.
No.
We should
But-
aspire. We should aspire to do something better. So we should aspire that the utility function and the error structure that we put on the data are going to be more correct. And you'll see that there are ways to do this.
Okay.
Finally, once I recover preferences, then I can extrapolate, because we want to extrapolate. We always want to extrapolate. You know, if I, for example, have data on your car insurance, then I know how risk averse you are about your car. But it doesn't mean that you will be exactly the same risk aversion when it comes to your portfolio, just to mention. So we actually need to think about how to extrapolate from the slices of preferences that we see to other domains. And if I have time, I will get to this point in the talk as well. Of course, now with machine learning, we think that we can extrapolate everything, okay, without even understanding how do we extrapolate. So we might get into this, but this is not the purpose of the talk. Does this make sense? All right. So
we also extrapolate from one person to another, or just from
it's
one person?
It's actually even worse.
Yeah.
Because many times the data that we have are not at the individual level. I cannot actually estimate the utility model at the individual level. I actually have aggregate data.
Right.
And if you think about aggregate data can never be consistent with economic rationality just because of heterogeneity. You might be consistent with economic rationality. I might be consistent with economic rationality, but our pool data is not going to be. So when you're actually implying this to aggregate data, it's just becoming a bigger mess.
Okay.
All right. Okay. So now let me go back to the basics. I'm going to take. I'm going to do something that you should never do. You know, as Austin Powers said, you have to live dangerously. So I'm going to live dangerously. I'm going to summarize like 75 years of research in 3 slides. And you know, this is very important research, because I actually think, you know, it's together with market experiments, let's say, it's the most impressive part of experimental economics, because there was actually a dialogue in choice under risk. There was a dialogue between experimentalists and theorists. Theorists wrote theories, experimentalists tested them, they found pathologies or peculiarities, the theorists adjusted the models. The entire Kahneman and Tversky, the first paper is 1979, it didn't came out of the blue. It basically started by a long history of a very impressive dialogue. I actually cannot think in economics about a more impressive dialogue between theory and data than choice under risk and the experiment on choice under risk. So of course, it all starts with what we call the Allais paradox, which I will show. Allais didn't do any experiment. Allais just did a thought experiment. So just historically, after Van Neumann and Morgenstern wrote expected utility, Allais invited everyone to a conference in Paris. I mean everyone. Everyone was there. Samuelson, Van Neumann, everyone. And this was actually an ambush. He ambushed Van Neumann and Morgenstern with the Allais paradox. And the rest is history. This is why the paper is called Ever Since Allais. So let me explain the Allais paradox. All right. So I want you to think about something very simple. I want you to think that there are only three monetary payoffs, H, which is larger than M, and M, which is larger than L. Okay, they can be positive or negative, it doesn't matter, but H is larger than M and M is larger than L. And now, in order to think about risk preferences, I need to think about probability distributions over these monetary payoffs, right? This is what risk preferences are. They are basically preferences over probability distributions. I can represent all probability distributions over these three payoffs in something that is called the Marshak-Mashina probability triangle. It was invented by Marshak in the 50s, and then reinvented by Mashina in the 80s. It takes us time to digest good things. But here is the construction. The horizontal axis will be the probability of the low payoff, and the vertical axis is the probability of the high payoff. So for example, this point, all vertices are basically sure payoffs. This is the low payoff, for sure. This is the high payoff, for sure. And this is the middle payoff, for sure, because the probability of the low and high is zero. So when I ask you, what are your risk preferences? I'm basically asking you, how do you actually compare points in the Marshak-Mashina probability triangle? Is this clear? This makes sense? All right. Now, it's clear that if you have monotonic preferences, if you like money, the arrows are increasing preferences. Why? Because when I basically move horizontally, I don't need to move horizontally here. I can move horizontally everywhere. What am I doing? When I move horizontally, the probability of the high payoff is fixed. And I'm shifting probability from low to middle. So of course, you should be better off. Exactly the same when I move vertically, I'm shifting probability from middle to high. So of course you should be better off. And if I'm actually moving like this and like this, I'm better off. Also, I move like this, I'm going to be better off. This is basically first order stochastic dominance. Does this is this clear? Okay, so Van Neumann and Morgenstern came with this and they said, we basically want to draw to you a map of indifference curves in the Marshak-Mashina probability triangle. I know that you're not used to seeing difference curves like this, to think that the difference curves are like this in a two-dimensional space, but that's indifference curves. Okay, so if you basically take the entire set of axioms of Van Neumann and Morgenstern, you will basically become to indifference curves like this. This is a map of indifference curves. Why? Think about it, why? The independence axiom, basically what the independence axiom does, the independence axiom actually creates that utility is going to be, expected utility is linear in probabilities. This is why the indifference curves are parallel straight lines. However, there is a lot more here. So let's basically start. In order to draw this picture, I need to make many more fundamental assumptions about human beings. First, there is a map of indifference curves here. What does it mean? Coherent. What does it mean? That through every point, there is only one indifference curve. This requires complete and transitive preferences, right? Because if preferences are incomplete, I will have holes in the map. If preferences are non-transitive, indifference curves will cross, right? This is what we teach in Econ 101. Secondly, the indifference curves are upward sloping. This is because of monotonicity with respect to first order stochastic dominance. And finally, the linearity comes from independence. So that's the problem of expected utility. It is so beautiful that any low-level brain, and of course high-level brain, can actually take a step. Because it is so beautiful and it's so neat. So basically what Allais did, Allais basically proposed the following experiment. Allais basically said to people, choose between A and B and choose between C and D. In order for Allais' experiment to work also, the A and B and C and D should be close to the actually edges of the triangle, which are low probabilities. It's hard for people to understand low probabilities. But in a sense, what is the Allais paradox? The lines connecting A and B and C and D are parallel to each other. So according to Allais, if you actually choose here B and here C, it's a violation of the linearity of the indifference curves. That's it. That's the Allais paradox, nothing else. So Allais, basically, as a theorist, basically gave it as a counterexample. Of course, a counterexample says that your proof is wrong, but an empirical counterexample doesn't say anything. So in any case, he showed it in this conference. We actually have the minutes of this conference to Van Neumann. And Van Neumann, I can't believe I say that I'm disappointed from Van Neumann. Van Neumann basically said, you're right. While Van Neumann had to say, why are you picking on me, on independence? You should pick on Samuelson and his completeness and transitivity. Why? Because, you know, when you give me and you say, oh, someone chose B and then chose C, it's a violation. I can say, yes, it's a violation of independence if people have complete and transitive preferences. But it might actually be that this violation is coming from someone that has non-transitive preferences. You cannot take a theory that has 4 axioms and say, I'll treat the 3 first axioms, which are both fundamental, by the way. I will treat them as correct, and my test of the 4th axiom will depend that the 3 other axioms are holding. This is you cannot do. This is why I think that our colleagues in behavioral economics are confused. This is not something that you can do. So now, this is not an experimental talk, so I won't get into it, but basically, if you think about it, there are hundreds, if not thousands of experiments of this type. And the purpose of this experiment is to understand the structure of the indifference curves in the Marshall-Machina probability triangle. But if you think about it, there is no methodology for us to do it. You can come with one experiment, I can come with another experiment. Even if you have infinitely patient subjects that will just do it over and over and over again, we can argue forever whether your choices are better than mine to actually recover the indifference curves. Because we have no micro theory in order to say what do we need to do. Now, nevertheless, this didn't disturb us from continuing. So if you think about non-expected utility models, the first generation of non-expected utility models called weighted expected utility, the indifference curves are going to be linear, but they are going like hypothetically meet outside the triangle. Okay. Then came Kahneman and Tversky. And Kahneman and Tversky actually, their indifference curves is actually like this. It's fanning in and fanning out. That's how the indifference curves of non-expected utility models like prospect theory would look like. Okay. So in some sense, also here, the slope of the indifference curves is risk aversion. The steeper they are, that's risk aversion. Also here, the steepness of the indifference curve is risk aversion and the curvature is loss aversion. But if you think about it, this has tons of degrees of freedom to accommodate everything like this. So it's not that Kahneman, this is my take, it's not that Kahneman and Tversky are correct. Their theory can never be falsified. It has so much degrees of freedom, it can never be falsified. There are methods we can talk about it, whether it actually adds any predictive ability over expected utility. So that's the starting point of what we are doing. All right?
But there are other theories around that can be falsified. So they have made an improvement at least by.
Let me say the following, that the first version of prospect theory basically had too many moving parts. And in addition to weakening independence, they also violated first order stochastic dominance. So then in 1992, they came with cumulative prospect theory to avoid violations of independence, violations of first order stochastic dominance. Yeah, you know, the parametric versions of all of these non-expected utility models will be expected utility with an extra parameter, so it's nested. So in some sense, you can falsify. Of course, you can falsify. I'll show you that there is a better way to falsify. All right. Also, remember that we are kind of, economic theorists. We write stories in Greek letters. We write stories in utility functions. So if you relax independence, you're still in the domain of writing utility functions. If you relax transitivity, well, what kind of story do we write? Because then there is no utility function, the choice is maximized. It's much harder than this. All right. Okay, so this is Colin Kemmerer summary of what we learned from all of these types of experiments. It's in the first handbook of experimental economics from 1995. Since then, we learned a lot more, but it's all the same. So let's continue. I let you read the message. The message from Colin is that basically this is the truth and all the truth and nothing but the truth. Okay, this is how we should do finance, for example. If you do finance only based on expected utility, then you're doing something wrong because investors are loss averse. All right, we want to do something else. We want to provide a comprehensive and non-parametric test of expected utility, meaning we don't want to focus on independence. That's the comprehensive part. We want to come with a test that will actually test expected utility as Van Neumann and Morgenstern wrote it. Because if there is a violation of transitivity, there is no point even checking independence. Because there is no utility function, the choice is maximized. So of course, the utility function cannot satisfy independence. It goes without saying. Right? So in that sense, we want to come with a comprehensive test. We want to test the complete representation of preferences, not to focus on any individual axiom. And we want to do all of these tests completely non-parametric. Because whenever I'm making a parametric assumption, then I cannot test it. So I want to make the test completely non-parametric, only based on revealed preference conditions in the data. Okay, so we want to tie our hands completely. Okay. And we will do it in 3 steps. The first step is from the 1950s, 1960s, 1970s. And these are Samuelson and Ozawa and Afriat. We are actually going to provide a test whether choices are consistent with utility maximization. We are going to call it rationalizability. And this is basically whether choices are consistent with the general axiom of revealed preferences. Then we are going to have a second test. We are not just going to test whether choices are consistent with any utility, any maximization of any utility function. We're actually going to narrow it to ask, are choices consistent with utility function that is actually monotonic with respect to first order stochastic dominance. And in all of these tests, look, I'm restricting the set of utility functions that can rationalize the data. So you cannot, of course, be more consistent with FOSD rationalizability than you are consistent with rationalizability. because I'm trying to rationalize it with a smaller set of utility functions. This makes sense?
Yeah.
And finally, we are actually going to see whether you are consistent with expected utility maximization. All right. So how do we do this? In order to do this, we need to move to a completely new domain. We need to think about it differently. We need to generate a completely new set of data. You know, most experiments that you can think about it, that are asking, what do you prefer, lottery A or lottery B? You know, it's kind of binary of discrete choice. These choices cannot provide a test of GARP, and of course, you won't have enough data to do non-parametric tests. Okay, so we need a very rich data set. So the way to do it, we started with these experiments many years, but the way to do it is actually using economic textbook cartoons. This is called the budget line. We all know it from Econ 1. And if this is the way that we explain trade-offs to undergraduates, this is probably the way that we want to do experiments. It's not an experimental methodology class, so we should skip it. Let me just say that we've been working on it for many, many years, or not just with university students, but with the most sophisticated nationally representative centers on which we have tons of data on individuals. We can talk for many talks about experimental methodology and experimental design. Let's just leave it for now. Let me just say what is important. We published papers over the years that actually showing that the results from these experiments have external validation. They actually predict outcomes in the real world. Most specifically, the people that are more consistent with utility maximization in these experiments, they have better economic outcomes. Much better economic outcomes. Controlling for everything else, they will accumulate more wealth, they will make better financial decisions, etc., etc., etc. I don't want to get into it. All right. But what is going on in this experiment? So you actually see the experimental interface that people see, and we are telling them the following: look, you can move your finger on the computer screen, the touch screen. You can move your finger on the computer screen. And by moving your finger on the computer screen, you are going to choose a point in this downward sloping line. Okay? Technically, people don't need to move the point on the line. They can move anywhere and minimize the distance. It's very user-friendly. We now do it with iPhones, and everyone can see it on an iPhone, and etc., etc. And then we tell them the following story. You can choose any point that you want on the line. But after you choose a point, the computer will flip a coin and will either pay you what you allocated for X or will pay you what you allocated for Y, but not to both. So now you see that's a decision under risk. Moreover, if you think about it, every allocation on the budget line is actually a portfolio of arrow securities after 10 arrow. And arrow securities are the basis of all finance, because it's a note that basically say, I will pay you $1 if something occurs and zero otherwise. So you can actually think about this, that this is a portfolio, X and Y, it's a portfolio of arrow securities. This makes sense? All right. So now let's suppose that I gave you this line, just for the sake of the argument. Do you agree? If you are infinitely risk averse, you should go to the intercept with the 45-degree line, because then you are not exposed to any risk. Make sense? They're buying full insurance, but it's very expensive in terms of expected value. If you are risk neutral, you should go to the highest intercept. It exposes you to a lot of risk. There is 0% chance that you'll get zero, but there is 50% chance you'll get zero, 50% chance you'll get this, and this is the highest expected value. The more risk averse you are, you should go down the line, and you're basically trading off a lower expected return for a lower risk. If, for example, you have low Von Neumann-Morgenstern expected utility preferences, then you should choose the middle of the line segment, right? It's like a Koch-Douglas function. This is what will happen. Make sense? All right, how do we do the experiment? In the experiment, each person will get 50 lines like this. I will say in a minute something about the number 50, but 50 is a large number. Only with this graphical design, you can actually do it so quickly. The lines are drawn in the following way, that at least one intercept is above 50. The scale is from 0 to 100. And when you ask me, Shachar, why, I will tell you, I actually have a theory that tells me how many lines I should do and what configuration of lines I should do in order to have a powerful test. Enough powerful. There are experiments that we did only 25 lines. There were experiments that we wanted to test other things. There were 200 lines. Okay, then you get into subjects fatigue, that there are issues, but you know, that's.
How long does it take to do 50?
It takes less than 10 minutes. The first few decisions takes time because people need to understand the game interface, but then you know they're basically clicking very quickly. I will show you more on this. All right. So now let's see. Let's see how. But this is not enough. This is not. We did it many times, but this is not enough to what we want. Why? Why? The answer is simple because the choice with two goods is very different than the choice with three goods or above. There is a big difference between choosing with two goods and three goods. Think about, for example, a very common structure of the underlying utility functions, additive separability. What additive separability means that the marginal rate of substitution between any two goods is independent of the level of the other goods, right? So of course you cannot test additive separability with only two goods. You must have three. Okay. Also, the behavior of all of these models are much richer with three goods, much richer with three goods. Okay, so the data that I'm going to show you today, most of the data is coming with experiments like this.
Oh, it's much more complicated.
You'll be surprised.
Actually,
No, you'll be surprised because first, when you say complicated, what measure of complexity do you have in mind?
human reaction to that as opposed to the previous one.
I actually have look. So I actually think it turns out that this is turned out to be not more complex. How do I know? Because consistency with economic rationality in the 2-dimension and 3 dimensions is the same. And if people maximizing some utility functions, we cannot say that they don't understand. They do. Maybe with 4 dimensions, which I don't even know how to show it because we cannot see 4 dimensions. Anyway, that's exactly the same, and you can think about it for now that the probabilities are just 1/3, 1/3, 1/3. Of course, we also did experiments like this under ambiguity when we don't tell the probabilities, but let's leave it for this. Does this make sense? It's exactly the same. You'll get 50 sets like this, and one intercept is above 50. All right? Okay, so now I want to show you some individual level data just to show you how rich our data are. And of course, I'm just going to show you a few subjects. I'm now becoming a psychologist. And so look at this person. And of course, these people are not representative in any way, but it will just show you the type of heterogeneity that we have in the data. So how am I going to show it? I gave people 50 sets like this with varying prices. I want to summarize for you their data in the following way. So for each subject, you will see, I will actually put all the choices in a unit triangle. And I'm going to do it in the following way. Here, I'm going to put the fractions of money that they put in the cheapest asset divided by what they put in all 3 assets, the cheap, the middle, and the most expensive. So I don't know what, for example, here you see Z was the cheapest because the highest intercept. Okay, but it might be that in other X would have been the cheapest. But I'm going to transfer the data like this. This is the fraction in cheap. This will be the fraction in the second cheapest. And this will be the fraction in the most expensive. Make sense? Okay, so first, before we are doing anything, take all of these bisectors. Do you agree with me that if someone satisfying first order stochastic dominance, the demands must be such that X cheap is larger or equal than X middle, larger or equal than X expensive? Otherwise, you'll violate first order stochastic dominance. Which means that all the observations have to be here in this part of the triangle. Otherwise, it's a violation of first order stochastic dominance. Make sense? All right, so let's see what's going on. So here's one person. There are 50 choices here, but you know, he's infinitely risk averse. So he always went actually to the equating the demand for the free security. So this person is infinitely risk averse. This person is risk neutral. He has like 48 choices in the cheapest security, and 2 times he had a trembling hand. Basically made a mistake and chose not the first cheapest, not the cheapest, but the second cheapest or the third cheapest. Make sense? All right. This person is a perfect expected utility maximizer. Perfect. Why? If you think about it, in this domain, just take the domain of 2 dimensions, like Y and X. Expected utility preferences now would look like these smooth, nice preferences, where the curvature of the indifference curves is risk aversion. If you are Leontief, you are infinitely risk averse. If you are linear, you are risk neutral. Because I generated prices from a continuous set in a random way, this is exactly what you should see. You should actually see a spread of the observations. You should not see for intermediate expected utility risk preferences, you should never see a heaping of observations on any measure 0 cent. Make sense? All right, so this is Van Neumann, and this is Kahneman and Tversky. Okay? If you took the behavioral economic sequence at Berkeley and you don't understand why this is Van Neumann and this is Kahneman and Tversky, you have to take it again. I don't know if they teach you this, but there is a problem. As you can see, there is something very, very different between these 2 types of behaviors. It's very, very different.
And the other ones.
And the other ones are just extreme. The other ones are extreme references, right? So if you think about it, take someone who is expected utility maximizer. At the extreme, infinitely risk averse will look like this. Risk neutral will look everything here. And any intermediate, there will be some type of a spread here.
So do you have a distribution of how your subjects fall in this?
Yeah. But yeah. Oh, I can show it. I can have a distribution of how they are risk averse and loss averse and everything, but you know, it's not kind of the purpose of what we do. We basically say, are they utility maximizers? Period. Maybe they're not utility maximizers. For example, this person cannot cross the street alone. It's hard to say, I'll show you, he is not utility maximizer. He's not loss averse, he's not expected, he is nothing. He basically needs a transfer to the psychology department. This is the problem.
How often do you see that?
We'll get to all of this. Okay. There is no point taking this person and starting to argue whether he's an expected utility maximizer or loss averse. Okay, he doesn't have a well-defined concept of risk versus return. And in order to be expected utility maximizer or loss averse, you need to understand the trade-off between risk and return. Okay. So there is no point talking about. All right. Any questions? All right. Let me just, before I continue, let me just very quickly explain this behavior. This behavior is consistent with Kahneman and Tversky, is consistent with a much more elegant model of Huygens of actually what is called rank-dependent utility. Prospect theory is not the most elegant in terms of the axiomatic foundation of non-expected utility models. And look what this person is doing. This person many times equates the demands for the cheapest and second cheapest, or to the second cheapest and the third cheapest. According to expected utility, if prices are different, then the demand has to be different. This is coming from smooth preferences. So now, when you get out of this Marshak-Machina probability triangle, you can really see how these two models are different. So you have power in actually identifying the difference. Okay, but the first question is not even this. Remember what the first question? The first question is rationalizability. Can we even think about people here as maximizing utility function? So here is how I want you to think about this. Think about which type of data I have. My data of every individual is going to be a vector of 50 prices and 50 associated allocations. Okay. And the test, whether choices maximize utility function is actually given by what is called the generalized axiom of revealed preferences, which is generalized, so there are less generalized. There is the weak axiom and the strong axiom that probably people learn in micro. But we need to use the generalized one. Let's not get into this. But let me explain to you how we do this. Does this make sense? Are we following? Okay. Can you tell me honestly how new it is? I'm teaching this stuff in Econ 201A, or at least I'm trying to the best of my ability. But I think sometimes it escapes us. So let me basically say, let me just use the board a little bit. Let me just use the board a little bit to illustrate what we are doing. And I'm going to do it in 2 dimensions, okay? Because of course, I cannot draw in 3 dimensions, okay? So let's suppose that I'm giving you a budget set. I gave you a budget set. And you chose this X1 on this budget set. According to the theory of revealed preferences, what do I know? I know that I gave you the freedom to choose. So if you are a maximizing individual, X1 must be weakly better than any other point on the budget lines. You might have non-strictly quasi-concave preferences. X1 must be weakly better than any point on the budget line, and by monotonicity, strictly better than any point below the budget line. Make sense? All right, let's continue. Let's suppose that now I'm giving you this budget line and you choose X2. Now, look what happens. I know that X1 is revealed preferred to X2. X2 is revealed preferred to everything else. So by the general axioms of revealed preferences, X1 is also revealed preferred to all of these portfolios that before were never observed. Does this make sense? And eventually, you can actually see that if I have 50 budget lines, even non-parametrically, by continuing to construct something like this, what I will be able to do, I will be able to non-parametrically actually estimate or get the indifference curve for X1. Does this make sense? All right.
Assuming transitivity.
Assuming transitivity. But so let's say, assuming this is a good point, I'll touch it in a minute. I'm going to test for transitivity. If there are violations of transitivity, I will have a problem constructing it, because the violation of transitivity will cause that the strictly preferred set and the strictly worst set will start overlapping. So there will not be a place for the difference curve to actually pass. Okay. So for example, if I have something like this, that won't work, because this is a violation of the weak axiom of revealed preferences. According to this budget line, X1 is revealed preferred to X2, but according to this choice, X2 is revealed preferred to X1. So there is no utility function that can rationalize these two set of choices, no matter which utility function. Okay. Now, so if you want to think about it, are we on the same page about what we are doing? All right. If you want to think about it, more broadly, let's suppose that I only made 5 decisions. People actually made 50, but let's suppose that they made 5 decisions. And let's put these decisions as nodes in a graph. All right? And now let's take the revealed preferred relations in the data, as I explained, and start drawing arrows. For example, I'm just making it up. Suppose that decision 3, allocation 3, the choice 3 that you made is inside the budget line on which choice 1 was made. Then I will draw an arrow from 1 to 3, meaning 1 is revealed preferred to 3. Make sense? Okay. So if I have something like this, that's a violation of the weak axiom of revealed preferences. It's a 2-cycle. But of course, I can also have something like this. Not this one, but this one. That's a violation of the general axiom of revealed preferences. Makes sense? Because 1 revealed prefer to 3, 3 revealed prefer to 4, and 4 revealed prefer to 1. Make sense? Okay, now you should be able to tell me also why a 3-dimension experiment is more important, is better than a 2-dimension experiment. Why? With only 2 goods, there are beautiful papers starting in the 50s that are basically saying with only 2 goods, any long cycle, a violation of GARP, must contain also a short cycle. It must contain. So you cannot distinguish from data with 2 goods violations of GARP and violations of WARP. Why this is important? Because if you only have violations of GARP, but you don't have violations of WARP, then your choices are non-transitive, but they are complete. So if we want to think about what is the problem, your preferences are incomplete or your preferences are non-transitive, we need to move from 2 to 3 as well. Make sense? All right. So of course, if you think about it, this is first look. This is with 50 choices. This is extremely rich. You have a large graph of actually 50 nodes, and you have many edges. That's the beauty of it. Okay, and let me tell you, everyone has violations, almost everyone. Why? Because the experiment is so strong that even a small trembling hand will cause that there are going to be some cycles. And let me tell you that even the structure of the cycles is extremely different among individuals. Some people might have isolated somewhere cycles, some people the cycles overlap. It's extremely interesting because it can also tell us that we didn't touch it yet too much, but it also tells you whether the violations are accidental mistakes, okay, maybe trembling hand, or it's a more systematic misunderstanding, for example. Okay, but in general, if you think about it, that's it. That's the end. Why? Because in graph theory, we have many measures that are basically saying the following. I'm giving you a directed graph that has cycles, and I'm asking you, what is the closest graph to it in some topology that has no cycles? And this is our measures of how far you are from actually economic rationality. It's basically coming from graph theory. Of course, some economists actually thought about it without looking at graph theory, but it's all different tests like this in graph theory. So there are a variety of tests like this, but all of these tests will give us exactly the same conclusion. So, we can skip it. Okay, we'll just use one test. And the one test that we are going to use is a test that was invented by Sidney Afriat, and it's actually called the critical cost efficiency index. You know, if you never heard the name of Sidney Afriat, it's because he's one of the most underappreciated economists. Basically, because Sidney Afriat was given to the scientific journal the take it or leave it offer. This is my paper, and that's it. I'm not making any changes. You can send it to referees, but I don't care. The paper should be written like this. And years after, Varian actually collected, and Sidney Afriat was not the best writer. So years after, Varian actually collected all the results that Sidney Afriat had and published it in a paper. And Afriat was very angry that he misrepresented what he did, even though no one understood what he did. So how could he misrepresent it? But anyway, so this is actually coming. This is actually coming by Sidney Afriat. I overlapped with Sidney Afriat once. It was 15 years ago. In some place, I visited, he visited. So at one point, my door is open. He comes into my office. He sits down, says nothing. So I said, "Hey, Sidney," and he said, "I came to see you." And I said, "And?" "I just came to see you." So we looked at each other for a minute, and then he said, "I had enough," and left. So that's my interaction with Sidney Afriat. We looked at each other, and that's it. And he had enough after a minute.
At a university.
In the European University Institute in Fiesole in Florence. Anyway, this is basically the CDAR. So you see, there is a violation here. That's the violation that I talked about. How can you remove the violation, quote unquote? You can basically shift back the budget line on which Y was chosen, or shift back the budget line on which X was chosen. What do we mean by shifting back budget lines? Shifting back budget lines is actually throwing away money. So you basically need to ask yourself, how much money I need to throw in order to rationalize this person? I know it's not a standard measure of noise in economics, because the standard measure of noise in economics will not be to shift the budget line, but to start shifting the choice. Like, you know, this is a McFadden approach to introducing additive noise. Anyway, we show in some paper, if you are interested, the two approaches are basically indistinguishable. There are computational issues. But in any case, to remove this violation, the CCI index is going to be A over B. Because this is how much you actually need to relax. You can also relax C over D, but this is penalizing the person more. Okay, so the CCI is between 0 and 1. When it's 1, you have no violations. The further you are away from 1, you basically say, I need to throw out. Or the person is actually leaving more money on the table, regardless of risk preferences, because he's making inconsistent choices. Does this make sense? So this will be our measure. This will be our measure.
Smallest amount of money
Smallest amount of money that I need to throw out
to make this thing.
to make these things
Free of cycles.
free of cycles. Exactly. Exactly. And it corresponds to some well-known graph theoretic algorithm. Does this make sense? All right. Now, so that's the first number. The second number that we will have is a number whether I can actually also consistency with first order stochastic dominance. But if you think about it, if the probabilities are 50-50, first order stochastic dominance is actually becoming only a symmetry of the utility function. That's what it means. And the way to actually test first order stochastic dominance in 2 dimensions is taking the 50 choices and actually flip the prices and flip the allocation. So you actually have 100 choices. Now, of course, when you do this, the CCI associated with a set of 50 choices can actually be no lower than the CCI with 100 choices, because you just have more opportunity to violate. Of course, when you come to 3 dimensions and you start with a data set of 50, each observation has actually 5 perturbations. So you're actually ending up with a data set of 300 observations. Okay? That's the test of first order stochastic dominance. If you think about it, the test is very strong because you are saying to yourself, okay, instead of looking at all utility function, I only look at monotonic utility function. Let me give you an example of something that is consistent with GAR, but not with first order stochastic dominance. Suppose that I'm also always choosing X. Always, I'm going to the maximum X. I like X. This is consistent with GAR. There will be no violations of GAR, but there will be tons of violations of first order stochastic dominance, because many times X is the more expensive security. Make sense? All right. So this is what I talked about first order stochastic rationalizability. And finally, so you can see here is a violation. So you see this budget line is steep. The person chose X. X is actually first order stochastically dominated by any allocation X prime on the other side of the 45-degree line. Because any allocation here are going to give you a higher expected return and expose you to the same risk. So you should never choose this. You should choose something in between. Because why? The mirror image of this point is that point. And that point is actually dominated by all of the points here. All right.
Risk is variance.
This is
Risk is variance.
risk is variance. Yes.
But people have different risk measures.
Like what?
95% CDAR. I don't know. I mean, people hate drug. So all of
No matter what risk measure you use, this is actually going to be, if you choose X when you can choose anywhere between here, that's a problem.
Okay.
It doesn't matter what measure of volatility you use.
Measure risk.
Yes, because the risk here and the risk here are the same. It's the same. But this has a higher expected return. Because this is exactly like this. Okay, this is just a higher expected return. All right. So now let me give you some results. The first results are actually interesting. Let's ignore this. Here, we are actually only counting the number of the cycles people had. And I'm basically going to give you, I'm giving you percentile values on the number of cycles. So you see the median person had in the 3-dimensional had 4 violations of warp and in the 2-dimensional 3 violations of warp. That's the median subject. But more importantly, look what we are doing here. Here we are actually calculating violations of GARP that do not include violations of warp. So of course, we can only do it in the 3-dimensional data. Okay, and you can see there are some people that have violations of GARP that are not violations of warp, but most people, every violation of GARP will contain a violation of warp, which actually means that the problems with people is just not just intransitivities, they are also incompleteness. That's what it means. This makes sense? All right. Okay, so now let me, in the 20 minutes that I have, let me show you some results. So first, before I do this, let me tell you, you see, this is a non-expected utility model for our data. Everything will fall into this, all of these models. So the models, the standard model, this is what is called rank-dependent utility, will say the following, that the utility has 3 weights that will sum to 1. And the weights are on the minimum demand, middle demand, and maximum demand. When these weights are all equal, then this is expected utility. When the weights are unequal, specifically, you actually put higher weights on the low payoff than the middle payoff than the high payoff. This is exactly what we call pessimism or loss aversion. Even though you know that probabilities are 1/3, 1/3, 1/3, you think that the God is against you and will always choose with a higher probability the lower demand. And if you think about it, when you actually move this not to be 1/3, 1/3, 1/3, this creates kinks in the indifference curves. It creates kinks in the indifference curves in equal portfolios, and this is what will generate this type of behavior that we saw in the scatter plots at the beginning of the talk. All right? Okay. Okay, so now just in 2 dimensions, here is a set of choices with 3 budget sets. This set of choices satisfies GARP, and it also satisfies first order stochastic dominance. Let me just show you that. Look at the 3 choices. So this choice is revealed prefer to this and to that. This choice is only revealed prefer to that, and this choice is revealed prefer to nothing. So there are no violations of GAR. Make sense? Also, there are no violations of first order stochastic dominance because all the choices are either on the 45-degree line or on the longer side of the 45 degrees. So there are also no violations of first order stochastic dominance. Does this make sense? All right. But this set of choices is not consistent with expected utility. It cannot be. What is the intuitive explanation? Look, according to these two sets of choices, the person is infinitely risk averse. But according to this choice, he's actually taking a lot of risk. And this is a split personality according to expected utility. You cannot do something like this. So what do you need? You need another parameter, another behavioral explanation. Why, in some situations, you are infinitely risk averse, and in some situations, you are not. What this parameter will be? Loss aversion. That's what will do it. That's what will do it. Because if you think about it, this line is actually, in terms of steepness, it's in between these two lines. So if on these two lines, you actually choose the 45-degree line, you also need to choose the 45-degree line on that line. Otherwise, expected utility is going to tell you what is going on, buddy. All right, let me actually show you that this is the case. Take a look. And let me go, it's here. So the slides are available, right? So it's I once gave it in the theory field exam in the second year. I gave this question, and it wasn't good. I got a pooling equilibrium. No one. I said, show me, is this set of choices consistent with expected utility? And if prove or give a counter example. And of course, it's not consistent, and it's very easy to show that it's not consistent. So look at this here. Look, there are two choices on the 45-degree line, AA and AA, gives you AA and BB, right? This has this choice, you see AA, and this choice BB. Let's think about the expected utility from these choices, okay? So the expected utility from these choices are basically equal to 2UA. Of course, the expected utility is actually 1/2 little u of A plus 1/2 little u of A, but I'm just removing the 1/2. So the utility from UAA is actually 2 little UA. And this is larger than U of B plus U of C. Why? Because if you actually go to the budget line on which AA was chosen, B and C was available. Does this make sense? All right. Then go to the picture and see it. Then go to the budget line on which the BB was chosen. So the utility is 2UB, and because it was chosen, it's actually going to be a higher utility than UA and UD, okay, which is available. But now, if you just sum these together, you will get that UA plus UB is actually better than UC and UD, and this is going to violate the fact that this is chosen on this budget. Now, what prospect theory will give you? Prospect theory will give you that you can actually play with the weights on these two utility in a very free way, as long as they sum to 1. But of course, if I can do this, I can accommodate almost anything. That's exactly the point. Make sense? All right. So we are going to have 3 numbers. I'm going to speak about these 3 numbers. The first number is the well-known Afriat critical cost efficiency index that we talked. We'll call it E star. This is consistency with utility maximization. Then we'll have another number, E double star, that can be no higher than E star because this is consistency with first order stochastic dominance and GAR. And finally, we are going to have something which is called E triple star, that is actually maximizing really expected utility. And if you take all of behavioral economics, bundle it together, all of these models should actually give you something like this, meaning people have complete and transitive preferences, they satisfy first order stochastic dominance, Kahneman and Tversky, as I said, even fixed prospect theory that this will work. So any behavioral model E star should be equal to E double star should be equal 1, but E triple star should be a lot below. This makes sense? All right, so let's see what's going on. Let's leave the power analysis. All right, so what you have here, this is E star and this is E double star. So of course, all the observations have to be under the 45-degree line because E star has to be dark. So, okay, so look, there are actually people, and let me tell you, it's a very strong test. So even if you actually tremble a little bit, your E star will fall to 0.9 or even below because the test is strong. But you can say even that the test is strong, there are many, many people that are actually quite good with utility models. And there are people on the 45-degree line, but you can actually see these are the deviations from all models, expected utility or non-expected utility. Okay? So when you ask me, are people utility maximizer and are they maximizing first order stochastic dominance? Well, look, this person, he doesn't have complete and transitive preferences, but he doesn't have additional violations of dominance. He doesn't violate first order stochastic dominance. Well, these people here, for example, they have complete and transitive preferences, but they have violations of first order stochastic dominance. But this is kind of the picture of how far people are from our models. And what can I say? I'm not moving to the psychology department. Because the psychology department basically saying, you know, every point here is different. We don't have a model to say they are all must be here. That's not the case. That's not the case.
What sort of subjects do you have? Are these students? Are these doctors? Are they finance professionals?
You know, this specifically are Berkeley undergraduates, but we did these experiments with a really representative sample of the US population, 5,000 people. So we have everyone. And I can talk about the relationship with socio-demographic, who is more rational and other things, but let's leave it for now. Let's stick to hardcore theory. All right. Okay, so now what I'm going to do, I'm going to flip. I'm going to put E double star here and E triple star here. And if really behavioral economics is correct, and really there are violations of independence after controlling for violations of completeness, non-negativity, and monotonicity, we should see many observations that are actually lying here. And that's not the case. Really not the case. So if you can see, there are indeed people that also, there is a reduction when you're actually coming and talking about the triple star, but look about all of these people. They are inconsistent with behavioral economics and they are inconsistent with standard economics. The same. And if you actually think about the deltas, this is the delta between one that I call this person. If all your indices are 1, I will call you Homo economicus, or like the ideal textbook version. And all economic models that we have, and this is the difference between behavioral economics and standard economics. This is where we invested all of our effort. But as you can see, the differences are here. They're not here, but a different place. Are the differences large or not large? Well, just like this. Okay. All right. And if you want to summarize, this histogram are basically reversed CDFs of the three indices. So you can basically read this. The red here is what fractions of subjects have a CCI score above 0.7. What fractions of subjects have a CCI score above 0.75, and so on and so forth. So, of course, according to all economic models, both the red and the green should be at 1. And the action should be the difference between the green and the blue. But as you can see, the behavioral economics is, I'm not saying that there is no difference. The behavioral economics is actually focusing on these gaps. Not the big gaps. I'm not saying that they are not there. They are there. These are not the big gaps. Okay? Now, let me just, in the time that I have, tell you that here we have something that is called ever since Ellsberg. This is basically taking exactly the same thing and moving it to talk about unknown probabilities, because that's the difference between risk and ambiguity. Ambiguity, I'm basically telling you, I'm going to flip a coin, but you don't know if this coin is even. You actually don't know anything about the probability of heads and tails. This is what we do. And I can show you the pictures, but the pictures will look exactly the same. No difference here. So you would actually think to yourself that when you introduce ambiguity, maybe it makes the problem more complicated, so people are going to violate more and many other things. The picture is actually pretty much the same. All right. So let me talk also a little bit, just teasing ever since Leibson, if you understand the joke. So I'm switching now from risk preferences to time preferences, just to actually show you that this is not only about risk preferences. Okay, so let's write a model of time preferences. I think it's also important, right? Do I want to buy this Tesla or save more for my retirement? Do I want to eat the cheesecake or eat the salad? Do I want to go to the gym or do I want to sit on the couch and watch another reality show? And these are all the trade-offs between my welfare today and my welfare in the future. And we model this trade-off by thinking about time preferences. How we are going to write a model of time preferences. First, we have to start. Preferences are complete and transitive. There is no other way, right? Getting out of it. And then we need something to put structure on the preferences. Okay. So what is the structure of the preferences? The structure of the preferences is coming from three different assumptions that were in the literature for years. One is called stationarity. The other is called time invariance. And the other is called time consistency. So these are three different axioms. There is a beautiful paper, if you are interested, email me and I'll send it to you, that basically shows that these three axioms are independent, but any two imply the third one. Okay. Now, if people by and large not satisfying this assumption, then what will happen? You ask someone, what do you prefer, $100 in a year or $110 in a year and 1 week? And you say, I'll wait another week and get $110, even if it doesn't even understand the interest rate is 10%. And then you actually take this trade-off and you bring it to today. You basically say, what do you prefer, $100 now or $110 in a week? Then there will be preference reversals. Because you basically brought this trade-off into the present, people will switch and they will actually take the lower and the earlier reward. This is what's called preference reversals. And this is why the behavioral economists think that we don't save enough for retirement, we don't eat healthy, we don't exercise enough. All the bad things in society is actually coming from these violations of stationarity. This is why we have models like beta delta, that is basically giving us all of this. Okay, so we can do exactly the same here. So we are going to basically change the experiment from choices under risk to choices that involve time. I don't have here. I think that there is a group of noisy people outside that want to.
They are, and they're going to be charging in here in 6 minutes.
All right. We can put one person who needs to and 5
volunteer.
Yeah. Okay, I'll volunteer, but I need to talk.
No, cannot volunteer.
All right. So we are going to actually do, I don't want to get into the experiment how we are doing it, but we'll do exactly the same experiment with budget time. Instead of risk preferences, we're actually going to do it with time preferences. So time preferences, it's even easier. Y will be money at time t, and X will be, or X at time t, and Y at time t plus S, and now you have an interest rate. Slope of the budget line is just the interest rate. That's it.
Yeah.
Easy. And we are going to do exactly the same tests. Exactly the same test. All right, so let me show you the test. So here is the test. So it's exactly the same reverse CDFs. The blue are whether choices are consistent with GAR, and the red are whether choices are consistent with GAR plus stationarity. Where is the focus of behavioral economics? Here on the gaps between the blue and the red. Not saying that there is no gap. get small. Moreover, and this will bring us back to what I talked at the beginning of the lecture, this asks whether there is any utility function that satisfies GAR that can rationalize data. And this asks whether there is any stationary utility function, but any function. Usually what we do in economics, we restrict attention to actually very particular functional forms, very specific functional forms. When we are talking about stationary utility function, we talk about exponential discounting. And when we talk about any utility function, we will talk about quasi-hyperbolic discounting. As a delta, basically. Okay, so we can also test these particular utility functions. What do you think will happen when we do this? All the bars will just shrink down because our models are just incorrect. All the bars will actually fall because these models are coming from our minds that have nothing to do with reality. And the difference will actually even shrink more. So if you restrict actually attention to this kind of nice models that we write, the difference between standard economics, the red, and behavioral economics, the blue, is actually becoming even smaller. Now, okay, let's stop it. Never mind. Now it's I don't know what it's about.
And for questions, but I think our email address is
Yeah,
now.
I'm around. I'm around.
Please direct questions to him next week. Watch for the announcement. We're still going. So thank you all for joining today, and thank you for
Pleasure.
fun experience.